Mike Tedeschi, Portfolio Manager at Perspective Wealth Plan. With this week's market breakdown video, we have a ton to discuss. We're going to take a look at the four major U.S. indexes. We'll also take a look at some of the commodities, as we have seen a large move in a number of areas of the market overnight as war broke out between Russia and Ukraine. Russia has invaded Ukraine, and that has sent the market below some important key levels, and it sent some commodities above key levels. Let's jump right into it. First and foremost, we have been watching this 4,200 zone in on the S&P 500. This has been the most important level going all the way back to the middle of last year in June. When we broke above it, we came back, we tested it and successfully held. A couple of months later, we tested it and we successfully held. And then a few months later, at the beginning of this year, when we had that sell-off, we came back down here and held and made that nice bounce. We were 3 for 3, and now we have broken below that level. And what has just occurred here so far at the beginning of this year is a move into support, a bounce back up, and our failure zone was right in this resistance area at 4,600. That was exactly where the bulls did not want to see that failure. So what we have is now we have a high, a lower high, a low, and a lower low, and that gives us finally a downtrend from a technical standpoint. Now, there are a few levels that we are going to pay attention to right here underneath of where we're at. The first one comes right actually in around that 4,100 zone all the way back to about that 4,000 level. And this is that area, and we'll zoom in for you guys to see it, from back in May of last year that we pulled back into. So there is the potential that this could be that knee-jerk reaction to headlines. We get that initial push below this level. We get people jumping in on the short side, and the market actually goes ahead and finds kind of support right here and actually does make that bounce. If we don't hold this zone, we really don't have a whole lot of support until we back this chart up and really zoom out and actually go back to our breakout in 2020. Our next major area of support here in on the market is actually right around that 3,600 level. All right, we're going to throw something up on the chart that I don't really look at a whole lot, but I want to look at a fib retrace. So we go from the low to the high, and we get some technical levels that we can watch for potential areas of support from a fib standpoint. And you'll notice where I drew this rectangle box is right there at that midpoint. Markets tend to move 2 steps forward, 1 step back, 2 steps forward, 1 step back, or in a downtrend, 2 steps down, 1 step up, 2 steps down, 1 step up. So I like to pay very close attention to that 50% retrace level. If the market doesn't hold on here, it would not be surprising to see us over the next month or two continue to drift down and test this major breakout zone that we had back in 2020. And so those are the areas that we're really paying close attention to at the moment. We jump in now and we'll take a look in at the Nasdaq. The Nasdaq has been the leader to the downside this year. It has been the weakest, and part of that has to do with interest rates. And again, a lot of tech names have those high growth multiples attached to them, and when the cost of borrowing money goes up, it typically tends to move a little bit of wind out of the sails for the tech area. Now, the interesting thing to note is the breakout zone in on tech that we're talking about from back in 2020 is not far below where we're currently at. Right, it's this zone right here. It's right at that 12,000 mark. And so if we look at the Nasdaq on a percentage basis to that major area of support, we're only talking 5 or 6%. Whereas if we go back to the S&P 500, remember our lines back down here, we still have another 13 or 14% to get back to that support. So that just goes to show you how much weaker the Nasdaq has been. Right, the S&P 500 is a much more broad-based look. And we know there have been pockets of strength this year, even in the down market, specifically at energy and material names. So commodities are still doing pretty well, and that does make up some of the names in the S&P 500. So that does explain why it has acted a little bit stronger so far. So we're really watching this 12,000 level in on the Nasdaq now as that next key important area. We jump in next, and we're going to take a look in at the Dow. The Dow has held up better. Right, it's made up of more of those value names, and we've seen more money flow into those value areas of the market so far this year. And its major level of support really comes back from that breakout, back in 2020, right around that 29 to 30,000 level. It's about 10% away from that area at the moment. So you can see it is just breaking underneath of that key 33,000 level right now, and we are really looking at that next major area of support back in around those 30,000. And just like the S&P 500, there is a slight area of support, and you can see it right here. It was the push up in March and then the back test in April of last year, right at 32,000. So there still is the potential for us to kind of find that bottom right here, right now, and kind of make that bounce, though the market and the indexes really do not look very good at this moment. The Russell has now taken out the low from earlier this year that was put in, just barely. It's that 1900 level, and you'll notice on the Russell, its breakout levels back at around 16.5 or so, and that's where we broke out in the previous November. So if this area right here doesn't hold, right, you're looking for that next area of support is about another 10 to 15% to the downside. And that's kind of what we're seeing with all of these indexes. If we don't hold on right here, and again, you can see a reason why the Russell would hold on right here. It ticked just a couple of points below that low from before. So, you know, it could technically hold right here, and it wouldn't necessarily be a breach of this level. But if it doesn't hold here, if any of these indexes really don't hold where we are right now, the potential for that next 10 to 15% downside is certainly there. And, you know, when we look at chart patterns, we're starting to see a lot of things like this. So here's the Russell. Here's a bear flag. It breaks down. It makes another bear flag, and it's starting to break down. These are not good charts. These are clear downtrends now that are in play with lower highs and lower lows. Bulls really need to see the market hold right here and for things to start to turn back up. Now, if we're looking at things that are breaking out, let's jump in and take a look in at the commodity space. First, we're going to take a look in at the U.S. dollar. The U.S. dollar is actually seeing a flight to safety, okay? Now, if you guys remember from the coronavirus pandemic right in the beginning, right, the U.S. dollar actually saw a bid to safety after about the first week or so, right? People didn't know where to stick their money, so they put it in the U.S. dollar. That tends to happen. And we've seen a big inflow into the dollar over last night after everything that broke out in Ukraine. And typically when you see the U.S. dollar having strength, you don't see strength in commodities. But this is why I say it's a headwind, but it doesn't mean that you can't have commodities continuing to rise. Because when we look at gold, gold clearly has won the flight to safety here over the last couple of weeks. We've gone now from 1780s all the way up to almost the 1980s. Gold so far this year is now one of the best asset classes, up 8% so far for the year after the push. And we have talked about these key levels. So 1920, we finally broke out above. We're now right at this 1970 zone. Over 1970, there really isn't any resistance until we get back up to that all-time high right around that 2100 mark. So gold is acting extremely well. We have talked consistently about this. It has put in higher lows now for the better part of half a year. We can see that, you know, that line right there. And now it's starting to put in those higher highs. This looks like a giant cup after, and again, I'll back this up and we can look at it on a monthly time frame. We had a huge monthly and yearly move, a year of basically sideways to downward action, and now making that next breakout. Gold is an area of this market that looks very, very, very good. All right. The only risk really essentially here is that the market was just bidding this up as a safe haven, and the geopolitical tensions ease, and we see money come back out of the safe haven area of the market. So there is that to keep in mind. Silver's back up over 25. We're looking at that to get back up into that 27 zone. And the platinum and palladium is really what we want to pay attention to. The reason is Russia is actually a huge producer of both. And so that is really a supply constraint with what's going on. So we want to pay attention to that platinum. If it can get up over that 1140 zone, this actually does look good for a potential move back up towards those highs. Palladium as well, right? Palladium, much more Russian focused. They are by far the largest producer there, with like roughly half of the entire global supply chain there. So that's seen a really big push. It is back up to 2,700, and all of this damage that has been done over the last half of the year has now been taken care of. We are back over that key 2,500 zone. We overshot to the downside, made a really strong bounce. We held up above that 2,200 and pushed up. So palladium still looks extremely, extremely strong here. I want to come in and take a look at bonds. Right. One of the things a lot of times that we see when we run into these risks is people, again, looking for that flight to safety, and one of the areas that they tend to take a look at is bonds. That worked out very, very well in the 2020 move, where we saw bonds made that huge push higher. Bonds have not been doing well because bonds run inverse to interest rates. So if we're going to get into an interest rate raising environment, bonds are not necessarily a good spot to be invested in. But we can see as soon as those tensions rose here over the last week or so, we have seen a pretty good bounce. This is still a very broken chart. There are still a lot of issues above. This is a tough, tougher area from a flight to safety standpoint, on a technical analysis standpoint, but it is certainly worth watching. If it can get back up really over that like 156.24 zone, you can run back up towards December's highs, and that would be a pretty decent sized move. Now let's jump in and let's take a look at our soft commodities. First, we'll take a look at corn. Corn has now pushed up, and it is almost back to the highs from last May. So we're just right at a spot here where it can make that big breakout. I want to back this up and look at it on a monthly time frame so you guys can see it. We're getting up towards those highs from 2012, right? So the all-time highs are really kind of in play here on corn if this can continue to follow through here to the upside. Soybeans, almost at those all-time highs as well. So we're looking in around that 1800 zone. That's a very, very strong push. Took out last year's highs and is acting really well. Wheat, another very strong move here. In fact, last night, wheat was limit up, meaning it reached the maximum amount of price that it could move in one day. We're going to watch for that to open up and follow through to the upside potentially here over the next days or so. You're getting back into those highs from back in 2012 and 2013 as well, and then you really don't have anything until you run back towards that 2007, 2008 zone with wheat. So you can see the soft commodities look good, right? The precious metals look good. Now let's jump in and take a look at our energy names. Gasoline, this is going to hurt when you go to the pump, is now trading up over $3, and that doesn't include all the taxes and everything else, obviously, that you're paying at the pump. So gasoline prices have soared here, and we are actually back towards that 2014, 2015 shelf area. We have a little bit more resistance until about 340 or so, and then it's really all-time high open to the sky. So we have about another 15% or so before there is no overhead resistance on gasoline. So this is certainly worth continuing to pay attention to. And then we've got oil hit $100 a barrel last night for the first time since 2014. It's a very similar chart. Really on oil, you don't have any resistance really over 114. I know you run all the way back up to almost 150 a barrel from back in 2008. That is certainly still a potential here, resistance point, but there's not a lot of resistance. And what I mean by that is when we look at the area that we're trading in right now, you got like 4 or 5 years of overhead supply where you traded in this zone versus basically a straight up move and a straight down move from back in 2008. So we're really watching oil right here. Over 114 a barrel does put the all-time high zone back in play. Two last things I want to touch on here today. We'll also want to take a look in at our cryptocurrencies, so we'll jump in and take a look at Bitcoin. I'm going to zoom in here on a daily basis. Right, it is not a flight to safety. We saw that back in 2020 where it got smashed along with everything else. It is a risk asset. We are still holding clearly above last year's low of the year, and we actually still are holding above the low that we put in a couple of weeks back. This is the really, really, really important zone for the crypto space. In between 28,000 and 32,000 in on Bitcoin, that's the area that the bulls need to hold. If the bulls lose this zone, you can see again when we're talking about price action, there is not a lot of support until you get back down into the low 10s, like 10, 12,000 in that area. There's a slight area at the 20,000 mark, but this would be a major top if we break below that 28,000 level. Now, what I will say in defense for the Bitcoin bulls, we have still higher lows and higher highs, right? these are just, it's just a huge volatile range. But this is technically still in an uptrend. We haven't broken below those major key levels at this point in time. So really since the beginning of 2021, even though we've had these huge 50+% price swings, we are still technically in an uptrend. And that's why this zone right here is so very, very important. So pay very close attention to it here over the next week or so, because what happens here is definitely going to be key for this market. If it can hold on to this zone, your next area that you need to get back above is that 45,000 level, and that would start to undo some of the damage that we've seen here over the last quarter or so. I want to jump in and take a look at our breadth readings. We have broken below the lows from a few weeks back, which is no surprise based on what we've seen on the charts. This is updated as of yesterday. So with the move that we're going to see today from the open, where the Nasdaq is opening almost down 3.5%, we are going to see this continue to drop. We're almost back to the lows in terms of the initial push down at the beginning of the pandemic from our breadth readings in on the Nasdaq. It is extremely ugly out there. The market bounced right up into resistance and failed right where we didn't want to see it, and we have rolled over since. So we really need to start seeing the market find that area of support and just start seeing some names start getting above that 200-day moving average. Right now it is clearly massive push to the downside with the majority of names underneath that 200-day moving average across the board in on the Nasdaq. We definitely want to compare the same thing to the S&P 500. As we've talked about the difference in strength between the Nasdaq and the S&P 500. We can see that we have almost 40% of names above their 200-day moving average versus barely 20% in on the Nasdaq. So there is a little bit more strength. But again, this is not a good looking chart. We failed right kind of at that 50-60 zone right in here and have continued to roll over. This is not what we want to see, and we again are starting to get down into the depths of where we were at during the beginning portion of the pandemic panic. So if you're really watching this in on the S&P 500, there is an area of support in at that 30 zone. That's the area you don't want to see us lose in on those breadth readings. I know we covered a lot of information in today's video, but the markets are at really, really important points. We've seen a lot of things break down. We've seen a lot of things on the safety side breaking to the upside. What happens here over the next week or so is very, very important. If there's anything you'd like to discuss with me in terms of the market, feel free to reach out. You can reach me at mtedeschi at Perspective Wealth Planner. You can give me a call at 814-580-9881. Stay safe out there. I will see you guys next week. Take care.